Hi, we have a new exam in the block, that is NiSM Portfolio Management Services Series-XXI-A examination. Anyone who is dealing with PMS as a product is expected to clear this examination, right? Now, when you compare this particular examination with mutual fund exam or NiSM Mutual Fund Series 5A exam, Series 5A is completely theory oriented paper, whereas PMS module has reasonable weightage given towards numericals. So this video, the series of videos, is aiming to help you understanding these numerical concepts and then how to use Excel in terms of these numerical questions or the concepts, and then so that you can help you can probably clear the examination very confidently. Okay, my name is Karthik. I've been in the financial service industry for last 19 years. I've been in the profession of financial training since last 15 years. I run a company called as Novise Learning Academy. So we have trained multiple batches, multiple set of people in helping them to clear PMS module exam. Okay, so without wasting much time, I think let's get on with understanding these concepts. Okay, now the first one, okay, the first chapter is primarily covers basic concepts of investing. Now, when we talk about basic concepts of investing, one type of rate of returns which matters the most for an investor is real rate of return. Okay, so there is one numerical concept which is tested on this in this particular chapter. What is real rate? I'm sure real rate of return is something which all of us are aware, and then we use it in our day-to-day practice on a thumb rule basis. Okay, let's understand this concept. Imagine you have an investment which is giving you 8% return. So what is happening on one side? Your money value is going up by 8% every year. On the other side, if the inflation is say 6%, what is happening? The value of your money is going down by 6% in 1 year. So if you were to, like let's say put together both these, what's happening? On one side you're gaining 8, on the other side you're losing 6. The net return left in your hand is 2%, right? So that's the general thumb rule what all of us have been using all this while. But interestingly, there is a separate formula for arriving at this real rate. What does the formula say? In simple terms, it just say real rate is equal to 1 plus nominal rate. So it is nothing but your investment rate divided by 1 plus inflation, whole answer minus 1. Okay, so now that means in simple terms, what we are doing is, in this example, what we just assumed, 1 plus 8%. Okay, so close the bracket, divided by 1 plus inflation. Our assumption is 6%, the whole answer minus 1. Now, like I mentioned earlier, in the examination, you're allowed to use Excel. So feel free to practice as we discuss, right? So that's the better way to really start solving. Now, when you apply this formula, okay, you would get an answer, right? I mean, I'm sure you would get an answer here. What would that answer be? The answer is 1.89%. How will you know whether the answer what you got is correct or not? You remember the thumb rule what we just solved? 6 minus 8, or sorry, 8 minus 6 is 2%. So that means you just did the subtraction and the answer what you got is 2. When you apply this formula, the answer what you get should be slightly less than 2. Right? It can't be more than 2. It definitely can't be far off from 2. It should be slightly less than 2. If you get slightly less than 2, that means it is safe to assume the answer what you got is correct. And what are some of the mistakes what people end up doing? One, while applying the formula, okay, not putting the percentage symbol. So some people might just put 1 plus 8 close bracket divided by 1 plus 6 minus 1. You will not get this answer. So don't forget to put the percentage symbol, or you can also write it this way. Okay, so that is 1.08 close bracket divided by 1.06 whole answer minus 1. So you can write it either way you want, you would still get the answer. Now, so this is just a brief of understanding this concept of real rate. Now, just based on this formula, around this formula, the question may or may not be direct. Sometimes it might be indirect as well. Okay. What could be an indirect form of asking the same question? Let's probably understand with this another example. Imagine if the scenario is your real rate of return is 4%. Okay, the real rate of return what you got from an investment is 4%, and if the inflation, okay, is 5%. The question could be, what is your investment rate? Okay, what is your investment rate, or nothing but what is your nominal rate? Okay, so now how will you solve this? Any numerical question, the general recommendation is don't sit and stare at the question, you will not get the answer. All you need to do is, take up the formula, replace the numbers what is already given, right? I mean, you already see some piece of information, you put them in that particular puzzle or equation, and then by replacing the numbers there, I'm sure you will be able to solve it, right? So what is the question is solving the nominal rate. So how would we write it? My real rate is 4%, so 4%, okay, is equal to, okay, 1 plus investment rate or nominal rate, that we don't know, right? Closing the bracket, divided by 1 plus inflation, that we know, that information is given, that is 5%, whole answer minus 1. Now all I'm just trying to do here is minus 1, let me transfer it to the other side. So that means what's happening, 1 plus 4%, okay, and if you see 1 plus 5%, that is inflation number, it is in denominator on the other side. So all you need to do is transfer it to the opposite side or to the other side. So when you transfer denominator to the other side, it becomes multiplication. So that means 1 plus 5%. Okay, and what is left? What is left is 1 plus nominal rate. Now, I just need to know the nominal rate. So all you have to do is you transfer 1 plus to the opposite side, then again it becomes 1 minus. Okay, so I would write the equation this way. My nominal rate is equal to, okay, the equation would look like this. So what is my answer? All you need to do is, if you were to just solve this, the answer is, any guess, anyone? Okay, always keep the rate related answers in 2 decimals. I think some technical glitch. Let me just fix it here. Format cells, percentage. Okay, 9.2% is the answer, right? Now, probably, how do you guess this answer? On one side, your inflation adjusted returns is 4%, but your inflation is 5. So that means your gross return or the investment return should be around 4 plus 5, that is 9. And here, remember, since we are multiplying, the answer what you get should be slightly more than 9. So when you see the options, any option which is less than 9 is definitely not the answer, and if it is far higher than 9, let's say 11, 12, 13%, that is also not the correct answer. So here, as per this, when we solve it, it is 9.2%. Okay, so that is from chapter 1. Now moving on to the next chapter. In chapter 2 there are no numerical concepts which are covered. Chapter 3 has certain numerical concepts. Chapter 3 deals with investing in stocks. So in investing in stocks, what kind of numerical questions or scenarios you think we would get? Basically, it is to arrive at what is the fair price of the stock. So when we say what is the fair price of the stock, the general concept what we would be looking at is basically, or what is expected from you, is to find out the intrinsic value. Okay, the intrinsic value of the stock. There are multiple methods which are followed, but from numericals point of view, there are 2 concepts which would be tested. One is on, or one could be on, what we call it as dividend discount model. Okay, and the other one is the relative valuation models, that is either on PE ratio or PB ratio, etc. So let's understand dividend discount model first. What is dividend discount model and how does it work? It is based on a basic concept that is of what we call it as perpetuity. What is a perpetuity? Perpetuity is nothing but a set of cash flows for an infinite period, or there is no end to that particular cash flow. Let's understand this with an example. Let us say there is a particular charity which is very close to your heart, okay? And you want to donate a certain amount of money or a fixed amount of that money to the charity. Let us say every year you want to donate rupees 10,000. Okay, now the point is you want to donate 10,000 rupees, that is fine, but you don't want to take the headache of transferring this money every year. So, what you want to do? You want to set up an investment through which what happens, whatever returns generated by that particular investment will will be passed on to that particular charity, and then your charity is kind of taken care. So the question is, how much should you invest in that particular charity? Let us say you spoke to a financial institution and that financial institution has promised to pay you 10% return. I understand no fixed income instrument in these days would give 10% return, but just for numerical simplicity, I'm assuming 10%. What is the scenario here? Every year you want to donate 10,000 rupees and a financial institution has promised to give you 10% return per annum. How much should you invest today, right? I mean, what should be your investment amount? Now, even without applying the formula here, and I'm sure many of you would have done the mental math already and then would say that the answer is 1 lakh. So what do we mean by answer of 1 lakh? That means if you invest 1 lakh rupees today, from next year onwards, at the rate of 10%, that is 10,000 rupees would be given away for charity. Till when this charity will go on? This will go on as long as the investments are held, right? So now, since it is 10,000 rupees per annum and 10% is the rate per annum, you solved the answer and then told that it is 1 lakh rupees is the investment amount. What if it was some odd amount in fraction? What if the rate was 6.75%? So doing the mental math would be tough. So can we put a formula to this? It's very simple. All you need to do is cash flow, or whatever cash flow you want to really here giving away, divided by rate. So that means it is nothing but 10,000 rupees divided by 10%. When you solve this, okay, so 10,000 divided by 10% would give you 1 lakh rupees. So that will tell you the money what you need to invest today. Okay, so this is what the example we have looked at so far. But on the other side, you work in the financial services industry or you're fairly familiar with this, how, like let's say numbers and financial concepts work. You also understand the impact of inflation. Let us say you want to donate 10,000 rupees per annum for a child's higher education or like let's say some form of educational support. Next year, 10,000 rupees might still make some kind of a difference, but imagine 5 years down the line or 10 years down the line, the same 10,000 rupees might not create the same amount of impact what you're looking to. Why? Simply because of inflation. So what you want to do here is you want to really give away 5% more every year. That means what? You are aiming to increase your cash flow by 5% every year. Right? So what's happening? Your cash flow, what you've decided is 10,000 rupees per annum. Your investment return is 10%, whereas at the same time, you're expecting the cash flow, that is this 10,000 rupees, to grow by 5% every year. Then in that case, how would you solve it? So all you need to do is, okay, in simple terms, it is cash flow, the same formula what we've looked at so far, divided by, let's put in the brackets now. Let's introduce the brackets. So the investment rate of return minus growth in cash flow. Okay, so what do we mean by this? If all I just need to do is 10,000 rupees divided by 10%, I'll put this in bracket, okay, minus 5%. So in a nutshell, I'm just saying 10% minus 5% is nothing but 5%. So 10,000 divided by 5%, whatever answer you get is the solution to the scenario what you're actually looking at, right? So, okay, what am I doing? So we are just allow me to copy and paste this here. Okay. The answer is 2 lakh rupees. What does this signify? If you invest 2 lakh rupees today, every year you will be able to start your donation with 10,000 rupees in year 1. In year 2 you will be giving away 10,500. Year 3 11,050. That means what? Every year you're increasing your cash flow by 5%. Right? I'm sure this concept is simple and clear. Then how is that we can apply this particular concept on the dividend discount model? Okay, how will this help? Right? Now let's understand the scenario with the stock example. Suppose you're planning to invest in a particular stock and all you have in mind is what is the fair price of the stock. And let's assume that stock is giving you a dividend of rupees 40. Okay, 40 rupees dividend per annum is what you are expecting or based on your experience. And okay, and since you are investing in equities, your rate of return, what you are expecting from equity is 12%. Okay, so this is your rate. Considering only these two factors, what is the fair price of the stock or what is the intrinsic value of the stock? Okay, what is the intrinsic value of the stock? Let's apply the same logic. What is my cash flow here? If you buy this stock, the cash flow is rupees 40. Until when will you get this? This 40 rupees generally it is assumed to be forever. As long as you hold the stock, you will get 40 rupees. And what is your expected rate of return from the equity here? It is 12%. So that means the intrinsic value of the stock should be 333 rupees. This is step 1. So in the previous step, we have assumed you're going to get the dividend of 40 rupees forever and your expected rate of return is 12%. Imagine how happy would you be if the company is giving you 40 rupees dividend forever. That also indicates that means the company is not growing. You would want the dividends to grow by a certain rate. Let's assume that you expect the dividends to grow by 6%. So that means what? The expected growth rate. Okay, the expected growth rate is 6%. In that case, if the dividends are expected to grow by 6%, what should be the intrinsic value of the stock? Right? Very similar to the previous example what we looked at with respect to donation. Let's apply the same logic here. All you need to do is cash flow, that is 40 in this case, that is dividends, divided by, let's open bracket, 12% is your expected rate of return, and minus your dividends are expected to grow by 6% every year. So that means 40 divided by 12 minus 6. So there's nothing but 40 divided by 6%. So that means is equal to 40 divided by 6%. The intrinsic value of the stock now after accommodating expected growth in dividend of 6% is 666. Now, I don't suggest you to mug up the formula. How do we arrive at this logically? So it is nothing but dividend 1, that is D1, that is dividend for year 1, divided by, instead of rate of returns for equity, the general term what we use, cost of equity. Cost of equity is denoted by K, okay, minus G. Okay, this is the formula for dividend discount model. Okay, so if you see the formula given in the book, it would look like this. P, that is price, is equal to D1, that is dividend for year 1, the whole answer divided by K, that is cost of equity, minus expected growth rate. Right? Very simple formula, straight one step answer, just replace the numbers given and then you have the answer. Right? There are no further variations which are actually discussed when it comes to the matter of dividend discount model here. Okay, so that is one concept in chapter number 3. Now, the second chapter, the second concept which is tested here is based on relative valuation methods, right? Okay, that is relative valuation method. So the most common one what we all use is PE ratio, right? Now, Very interestingly, PE ratio itself gives us the formula. What is the formula? PE ratio is equal to market price, or nothing but it's just simply price divided by earning per share. Okay, so when you look at PE ratio, all the variables what is taken into consideration is the value per share. So when you say price, it is price per share divided by EPS, stands for earning per share. What is earning per share of a company? It is nothing but the net profit generated by the company divided by number of shares issued by the company or number of shares outstanding. Right? So now, what kind of questions or what kind of scenarios we might actually come across in the examination? Let us say the scenario given to us is, let us say there is a particular company whose profit after tax is 9 crores. Okay, the current market price of the stock is 40 rupees. That means the stock is traded at 40. If you look at the historical average PE, the average PE number is 20, number of shares is 1 crore. The question which probably you could have asked is, what is the intrinsic value of the stock? Now, when you look at this piece of information, right, and if the question is what is the intrinsic value, I think you would probably get lost here. Why? It's simply because, okay, how will I find out the intrinsic value or how will I find out the price? It is already given, right? Again, like I said, I'm repeating this again. You don't sit and stare at the information or the data given. Just write down the formula, replace the values given in the formula, and then put the question mark at the place what you're supposed to solve. Now, based on the information what you see here, you can find out the intrinsic value only via PE ratio. What is the formula for PE ratio? We have already covered, right? PE ratio is equal to price divided by EPS. Is that right? Yes, that's the one, right? So now we have PE ratio, that is 20, is equal to, what is the question? The question is on solving the intrinsic value, right? That is nothing but price. So price, let's put the question mark there, divided by earning per share. What is earning per share here? They have not given that information directly, whereas they have given information on profit after tax and number of shares. Profit after tax is 9 crores, right? And then number of shares is 1 crore. So that means earning per share is rupees 9, isn't it? So how did we solve this? Is equal to, that is profit after tax, that is 9 crore divided by number of shares outstanding 1 crore. My earning per share is 9. Right? So how do I solve this? I mean, just transfer 9, which is in the denominator, to the opposite side, just multiply. So that means the intrinsic price is equal to 20 multiplied by 9. So 20 into 9, we are just simply saying 180, right? So the intrinsic value of the share is 180. Let us say if the current market price is 200, okay, if the current market price is 200, then there could be second question which would ask whether this particular stock is overpriced or underpriced, right? So the intrinsic value, that means according to you, the fair price of the stock is 180, but whereas in the market it is being traded at 200. So that means simply you can come to a conclusion that this particular stock is overpriced. Okay, so that's chapter number 3. So we have covered numericals in chapter number 1 and 3. In the next segment, we will cover numericals from chapter number 4, that is bond valuation. Welcome back. So we were covering the numerical aspects which are there in NiSM PMS module 21A. In the previous video, we had covered the numerical concepts which were covered in chapter 1 and 3. But now we'll skip to, or we'll move to chapter 4, that is on concepts of bonds or debt markets. So in this particular chapter, the numerical area predominantly lies with the concept of bond valuation. So many of you might think bond valuation as a topic is difficult. Probably let's skip this. But I personally recommend is a very easy chapter or an easy segment. Please focus on this. If you get a couple of questions, I'm sure you should be able to crack it with one-step solutions. Okay. Now let's deep dive into bond valuation now. Before you understand bond valuation, it is very important for us to understand the terminologies. Many of us probably fail here. right? What are some of the terminologies we come across? Okay, there's some of the very prevalent and regularly used terminologies are face value of a bond. Okay, face value, or in simple terms, let's call it as FV. And then we have coupon and we have tenor. What is a face value of a bond? Many of you might assume face value is the issue price. Not necessary. There are certain bonds, for example, treasury bills could be they are all issued at a discount and they're redeemed at par. So that means imagine if a bond is carrying a face value of 100, at the time of issuance you pay only say 97 rupees. At the time of maturity the government will give back 100 rupees to you. So that means face value not necessary to be issue price. Face value is nothing but the maturity value. At the time of maturity, the money which would be given by the issuer. Right? But now the question is, why do we call it as face value? Why can't we simply say maturity value? Right? We'll come to that answer. The next terminology is coupon. What is coupon? Coupon, the common term we all know, it is nothing but the interest paid that particular bond. Why can't we say interest? Why do we say coupon? Right? I'll answer that as well. And then we have tenor. What is tenor? It is the term the bond has been issued for, right? For bond valuation, what you need to take into consideration is leftover maturity or the residual maturity, number of years left in the bond for it to mature, right? So these are the three simple variables what we need to take into consideration. The question which went unanswered is, what is face value? Why do we call it as face value? And why do we call it the word coupon as it is, right? Now, when you look at a physical bond, I think it will be a lot more easier and clearer for us to understand. Okay, the image what you see here is an olden era government bond issued by US government, right? And if you see this particular bond, what is the face value of this bond? It's printed here, that is $100. And interestingly, why is it called as face value? Very simple, it is printed on the face of the bond. And what is the interest offered by this particular bond? Interest offered is like, let's say 2.78% of the bond, like 2.78% or whatever, right? Around that rate. Now, let's assume the closest number to be assumed is say 3% is the interest offered by this bond. Why do we use the word coupon rate? Why can't I just say interest? If you examine this particular bond in detail, if you see right at the bottom of the bond, physical interest coupons are attached along with the date of payment of the interest. So what does it mean? The interest paid by this particular bond is nothing but closer to 3%, that 3% of face value. So interest is already calculated as a percentage to face value, and that is already printed and given away. The question what you need to ask yourself is, can the face value of the bond change? No. Why? Because it is printed and given away. And how much interest you earn when you buy this bond, irrespective of at what price you're paying, the interest earned is also pre-decided, because if you see, the coupon already carries the interest amount along with the specific date, right? So that means what? In bond valuation, the two constant factors are face value and coupon. Rest everything generally, let's assume it keeps on changing. So what do we mean by bond valuation? How does it work? Okay, let's go with the general assumption. Let us say I bought a bond which was issued in the month of August 2023, right? And it carries a face value of rupees 100, and it is for a tenor of 3 years, and it is at a coupon of 6%, right? This is the 6% coupon. This is the bond which I bought. And all these bonds are listed and traded in secondary market. What do you mean by this? Like how you can buy and sell shares in the secondary market, that is stock exchanges. These bonds are also listed and traded. So that means if I want to sell it to someone, I can sell it to anyone who is willing to buy this bond in the secondary market. But interestingly, what happens? For this particular bond, coupon is 6, that is fixed for this bond. It doesn't mean in the market the interest rate offered by the market keeps on like let's say remain same all through. That doesn't happen, right? That keeps on changing based on various factors. Interest offered in the bond market keeps on changing. Let us say for some reason, let us say inflation went up, and to manage inflation the central government has, or central bank has, increased the interest rates. Now the rate prevailing in the month of September, okay, is 7%. Okay, fresh bonds are issued at 7% in the month of September. So the point is, I have a bond which was issued in the month of August. I bought it. I want to sell my August series bond to you in the month of September. Will you buy it from me as it is? No, right? It's simply because if you were to lend the same 100 rupees in the market, you're going to get 7%. Whereas if you were to buy my bond as it is, you're going to get the interest of 6% only. Right? So then that means the trade should not happen. Trade cannot happen here. So how will I exit from my bond and how will I compensate you? Because in the month of September, your expected rate of return is 7%. Let us say I will probably offer you, I'll tell you, look, I paid 100 rupees to the government, but you don't have to pay me 100. I will give you, say, I'll give you a discount. Let's say hypothetical number, let's assume it to be 97 rupees. So that means what? You are buying my bond, that is August series bond, for rupees 97. Okay. So now what's happening? Are you compensated in this particular example? Yes, right? How much interest would you be earning? You are buying my bond, remember, you are earning interest of 6%. 6% on, not on 97, it is on 100. Remember, it is always calculated as a percentage to face value. So that means the interest amount is rupees 6, and whereas the market price of the bond is 97, or the price agreed between you and me is 97, right? So is your rate of return more than 6%? Yes, right? Because your investment amount is only 97, you're earning an interest that is absolute interest of 6 rupees. Just using these two values, we will discuss the first concept, that is what we call it as current yield. What is current yield of the bond? Current yield of the bond is nothing but the interest amount, that is in this example it is rupees 6, divided by the market price of the bond. 6 divided by 97 is what we call it as current yield. Okay, let me just put it as number 6 divided by 97. Okay, so 6 rupees divided by 97. In percentage terms, my answer is, like I said, always keep in 2 decimals. The current yield of this bond is 6.19%. Okay, what is current yield? Interest amount divided by market price. Now you all must be wondering, how did I arrive at this 97 rupees? We just said the bond has to be sold at a discount. The discount value could be anything. It could be 98 rupees or it could be 91 rupees. How do we arrive at a common ground where buyer is okay to sell and then seller is okay to buy it? That means where both the buyers and sellers have to come to a common ground. So in that case, so this is where we cover it in the concept of bond valuation. So how does it work? When you are buying my bond, in this case you are buying my August series bond, you are going to get cash flow for 3 years, isn't it? So what are the cash flow for year 1, year 2, year 3? You're going to get year 1 6 rupees, year 2 6 rupees, year 3 106 rupees. How are you getting 106 rupees? 6 rupees is the interest component plus 100 rupees, that is the principal repayment, that is face value, right? So this is the cash flow what you're going to get over a period of 3 years. And your expected rate of return in the month of September is 7%, right? So what are we trying to do? We are trying to discount, okay, we are trying to discount all these future cash flows back to present value. That is what is the value as of today. That's it. That's the intrinsic value of the bond. How can you solve this in a very simpler way? In Excel, you can use certain functions. Okay, what are those functions? What is that function you can use, right? Let's write down those functions which are useful for solving bond valuation. Let's start with PV. PV stands for present value. right? This is my present value. The second one is rate, okay, rate of return, okay, and third one is NPER, that is number of compounding periods, okay. Then PMT, then PMT stands for payment, okay, and future value and type. All you need to do is these 6 variables. Write down these 6 variables in this particular order and replace the numbers or the question given. Just replace it and put the question mark at the place or whatever function you're supposed to solve. Now, interestingly, when we look at bond valuation, most likely, okay, majority of the questions, either you would be solving present value or you would be solving rate function. So that means either you'll have to apply or look for PV function or the rate function. That's about it. Okay, now let's fill in the blanks. You are buying my bond. Okay, what is this 100 rupees? If you buy my bond and hold it till its maturity, you're going to get back 100 rupees. So that means this 100 rupees is your future value, correct? Now, in bond valuation, type is always 0, okay? And like let's say it's safe to assume it to be 0. Even if you don't enter 0, Excel by default assumes it to be 0. Now, the second one is when we say payment, or it is nothing but cash flow. If you buy my bond, what is the cash flow you are going to get? Always remember, payment is nothing but the coupon amount or the interest amount you'd be earning from my bond. So that is 6 rupees. 6 rupees for how many years? It is 3 years. And what is the expected rate of return, or what is the current rate running in the market? Okay, as per this scenario, as for September, the current rate running in the market is 7%. Keeping these scenarios, what is the intrinsic value of the bond, or what is the present value of the bond, right? So all you need to do is insert present value function. So okay, either you can go and insert the formulas here. It's based on the type of Excel sheet what you're using, which version. The UI part would change a bit here and there, but otherwise larger segment, whether it is open office or Excel, any version, the modality is same. So what I would suggest is click on FX here and search for PV. Okay, it's all in alphabetical order. Okay, search for PV. In some cases, if you have a different version of Excel, there when you click on that insert function box, look for most recently used formulas, change it to financial function. Okay, search for financial after most recently, and then go in the alphabetical order, you will find PV. So insert function. So now Excel is asking you to input the values. What are the input values it is asking for? First is it is asking for rate, that is 7%. That is your expected rate of return. NPER 3 years. You have 3 years to go for this particular bond maturity. Payment, that is interest amount, that is 6 rupees. Future value, at the end of third year, you're going to get 100 rupees back. And then type is 0 and you click on done. The answer what you get is 97.38. Okay, let me just repeat this once again. Look for PV function, insert function, and then start giving the cell reference, right? Rate is 7%, NPER is 3, payment is 6, future value 100, that is this is the money what you're going to get at the end of third year, and type is 0. Click on done. The present value is 97.38. Now you all must be wondering, why is this in red or in bracket? It is nothing but it is negative symbol, right? So in Excel, you should always be able to identify cash inflows and outflows. How does cash inflow, outflow work? How will you recognize them? Very simple. Look at your bank account. If money coming into your bank account, cash inflow, money is going out of your bank account, cash outflow. When you buy a bond, you will be earning interest. That is, interest earning is positive. Money coming into your bank account, that is why it is positive 6. And at the time of maturity, you're going to get back the money what is in the face value. So that is also in positive. And in bond valuation, your present value is always negative. What is a common mistake what people do? When you're entering the values, not putting present value in minus symbol. Okay, that is one mistake. So don't forget to put, if you don't put minus symbol, you will not get the rate as an answer when you're solving a rate function. Okay, next, rate, not putting the percentage symbol here. And what do you use as rate? The rate is nothing but you use YTM in the question given, or nothing but the current market rate, whatever is the rate running. So that is what you need to take into consideration. Never put coupon rate in this particular rate. Whenever, like, let's say in the bond valuation, when you're entering the rate, don't put the coupon rate. You will use the coupon rate only to arrive at the payment or what is the cash flow. Okay, remember that. So these are some of the common mistakes what people end up doing while solving a question like this. Let's look at one of the question which was given in the book, and then let's see how to solve it, right? Now, let us say a bond at a face value of rupees 100, it is a coupon of 6%, and residual maturity of the leftover maturity is 3 years, and the current yield is 7%, or the not current yield, the YTM or the current market rate is 7%. Using this, what is the bond price or what is the intrinsic value of the bond? Now, even without solving this particular question, how do we really arrive at the answer? Remember, okay, very similar to the previous question, but we all know this thumb rule, right? What is the thumb rule we know? If the interest rate in the market goes up, bond price goes down. So in this example, coupon rate is 6, whereas market rate is 7. So that means interest rates in the market have gone up. So ideally, the answer what you get, the market price of the bond should have gone down, should be lower. Should be lower to what? It should be lower to face value. So out of 3 or 4 options, any option which has the value of 100 or more than 100, that is not the answer. How much lower? Okay, remember we are looking at 3 years. So approximately 3 years, right? So 6 and 7, we are talking about a return difference of 1%. So 1% for 1 year. So approximately when we say 3% for 3 years, when you take a compounding effect, the final answer should be slightly less than 3%. So the answer should be around 97 or 97 change, right? So that is what you should be looking at. So when we solve, it should have looked like this. Face value 100, payment of 6, NPER is 3, that is number of years to go for maturity is 3, the current rate running in the market or YTM is 7%. Applying PV function, the answer I got is 97.38. So ideally, you just need to apply PV function if the question is on calculate intrinsic value. That's it, as simple as that. Now, what could be the variation to this? The variation to this could be, while giving the information on coupon, they would have given you or they would have told you this coupon is paid on semi-annual basis. What do you mean by this? You would earn interest once in 6 months. Now, what will change in this? So some of you might be thinking, okay, I am going to get 6% interest for 6 months. That is not the case. Interest rate is given, whatever is given is always annual terms. Okay, interest rate given is always in annual terms, but it is only the payment frequency changes. What are the things you will change if this is the question, right? I mean, like, let's say you need to find out the intrinsic value. The scenario what you change is very simple. All these 3 factors, because all these 3 are in yearly nature, right? I mean, let me just change the color so that you can understand this. That is rate, NPER and PMT. All these numbers are in yearly numbers. These 3 need to change. If you buy this bond, if 6 rupees is the interest what you're going to get per annum, what is the interest which you're going to get for half yearly? Half yearly, you're going to get the interest of 3 rupees, right? Now, what is your NPER? That means how many interest periods you're going to get. So it is not 3 years. Over 3 years, you're going to get 6 interest payments, isn't it? In a year, semi-annual means 2, and means like let's say 3 years means 6. So the answer would change to 6 in NPER. And then rate, if the current market rate is 7% per annum, you should convert this also in semi-annual basis. That is 7 divided by 2, that is 3.5%. Okay, now effectively what have we done? We have converted all annual numbers into semi-annual. Okay, my 6 rupees interest, I'm dividing it by 2, that is 3 rupees is the interest amount. 7% per annum divided by 2, that is 3.5% for 6 months. And then In a year, semi-annual means I'm going to get the interest 2 times. Over 3 years means I'm going to get the interest 6 times. So you just need to apply the present value function all over again. The answer what you get is 97.38. Okay, so these are the two different variations what you get in you could get in this particular question. What is the third scenario? The third scenario is where you have been given the intrinsic value or the current market value, you have the coupon, you have the face value, all that information is given. The question could be on calculating the YTM. So calculate the YTM, like that's a simple question. Let's see if there is how to solve this, right? Now, let's look at this scenario. The question is calculate the YTM. The bond's face value is rupees 100. Very similar scenario. Coupon is 7%. That means how much interest amount you would be earning? You would be earning an interest amount of 7 rupees. Okay. So the coupon, you should put it as PMT or payment. Residual maturity, that is leftover maturity, is 3 years and the current market price of the bond is 104. Now, what should be the bond's YTM? Even without solving, can you take a guess what could be the approximate YTM of this particular bond? We'll go back to the thumb rule. What has happened? The market price of the bond has gone up. That means 100 rupees the face value, but it is trading at 104. The prices have gone up. If the prices have gone up, what should happen to the yield? We all know the interest rate and the price moves in opposite directions. So that means technically the interest rate should have gone down. When we say interest rates have gone down compared to what? Compared to coupon. The answer should be slightly less than 7%. That is what YTM is, right? So now how do we solve this? Apply all these 6 variables, write down these 6 variables and whatever information given, based on the information given, fill in the blanks. As simple as that. So now, as per this example, you have a face value of rupees 100. Where would you plug in the face value? Face value is nothing but future value. That means this is the money what you're going to get back after 3 years. Okay, that is 100. Now, what is my interest amount? My interest amount is 7 rupees. Okay, and type is always 0. Like I said, in bond valuation, by default, you put the type as 0, and NPER is 3 years, and the present value of the bond is 104. Okay, this is the information what we have taken down, and then you just apply the rate function. Now, even before we applying the rate function, do you think have we done any error here? Look at it closely. You remember we had discussed the present value of bond always has to be like negative. Why negative? Because you are investing money in this bond. Like if you are buying this bond, the money is going out of your bank account. That's why it has to be negative. So don't forget to put the negative symbol. Rest all seems correct, right? Let's apply rate function. So all you need to do is click on FX here. I'm repeating this. Click on FX here and search for rate. Okay, and insert function. Right now, it is asking for NPER, that is 3 years to go. PMT, that is interest amount, 7 rupees interest per annum. Present value, bond at present traded 104 rupees, and future value is 100. Type is 0, and click on done. The answer what you get is 5.52%. So that means what? The interest rates in the markets have gone down. That's why bond prices have gone up. So that is how you arrive at the answer. Just like I said, all you need to do is either solve present value function if the question is on intrinsic value. If the question is on calculate the YTM, then apply rate function. That's it. Using these 2 functions, most of the bond valuation questions can be answered. As simple as that, right? In some cases, mind you, they might have given the face value as 1000. Okay, and the market price might be as 1040. In that case, okay, just need to change the numbers here, and then what happens is, if there is one question, if you have solved on the face value of 100, then in that case, what happens with the interest amount, that is PMT, sometimes you do a mistake of putting it as 7 rupees as it is. Remember, 7% on 1000 is 70. The answer, what you should have written here is 70, and this is 1000, and this is minus 1040. The answer is again same, 5.52%. Okay, So be mindful in the exam if the question is where the face value and the market value is 1000 or generally hundreds. These are the two most commonly used numbers. And the last concept is on call option and put option of a bond. What is call option? What is put option? So we are not talking about call option, put option of derivatives. So here it is a much simpler version what is there in the bonds, right? Now, a call option of a bond is nothing but as a issuer of the bond, I have an option to call the bond back. Now, I cannot call the bond back anytime as per my whims and fancies. I should have informed all the investors at the beginning or at the time of issuance itself. Imagine I am issuing a bond for 25 years. Okay, that means I'm taking a loan for 25 years. Okay, and at the time of issuance, I'm giving you an interest of 9%. Right now, the interest rate running in the market is say 7%. So tell me something. If I can borrow fresh loan from the market at 7%, then why should I pay you 9%? In that case, I can exercise my call option. When it comes to the matter of call option of a bond, generally these call option cannot be random. Call dates are mentioned and call amount is also, call price is also mentioned, because you as an investor, you will be at the disadvantageous position if the bonds are called back. So I will say, let us say this is a 25-year bond and I have my first call option in 5 years, right? And on that day, if I think it is beneficial for me, that is as a issuer, only then I will call back. Remember, it is an option, it is not a compulsion. Okay, now how does this kind of scenarios work in a numerical way, right? So the question could be, okay, yield to call. The question could be, the face value of the bond is 100, the coupon is 7%. Okay, very similar example like previous ones. Residual maturity, that is leftover maturity of the bond, is 8 years. Okay, the current price of the bond, okay, is 104. The bond is traded at 104. Number of years to call is 4, and then let us say the call price, okay, the call price is, let's say, 103. Okay, call price is 103, current market price is 104, number of years to call is 4 years. Then what is the yield to call? So how will we solve this? Very similar to previous one. All you need to do is write down the information here. And yield to call means, again, yield is nothing but you need to apply the rate function. Okay, now let's go with face value first. When the bond is being called back, remember the question is what is yield to call, YTC. When the question is yield to call, the general assumption is you are surrendering the bond when the bond is being called back after 4 years, right? So when the bond is being called back after 4 years, the price, the call price is 103 rupees. That means the company is going to pay back 103 rupees, not 100. How much interest would you earn? You would earn interest of 7%. 7% on what? It is always on face value, that is 7 rupees. Okay, N per, how much would you consider as number of years? 8 or 4? We are considering call, so that means it has to be 4. We are supposed to solve rate, and then the bond is traded at 104 rupees, right? Again, this 104 has to be negative. Let's put minus symbol. Just solve rate function. That's it, right? So apply rate function. N per is 4, PMT 7, present value is minus 104, future value is 103, type is 0. When you solve this, the YTC, the yield to call, is 6.51%, right? So what we have covered is chapter number 4 on bond valuation. All you need to do is in Excel or in OpenOffice, use present value function or rate function. If the question is on solving intrinsic value, that means in simple terms, you need to apply present value function. If the question is on solve YTM, then just use or look for rate function to solve questions in this. Okay, so please like us, like this particular video, subscribe to us. In the upcoming video, I will cover from the remaining numerical concepts from the remaining chapter.